What's up, guys? Welcome back to another episode of Behind the Facade. In this week's episode, I am going to analyze some of the drivers behind the current hot housing market, as I believe a lot of people consider it. And one of the reasons why I'm doing this is because I got a message from a listener, and he wanted just to know my opinion on the market. And his opinion was that prices in his area had hit a certain level. And he was just of the view that he hadn't seen prices like that since 2008. And therefore, he has taken the view that we are on the verge of a crash, another big, huge crash. And on that basis, he is out. And he's going to get out of the market and he's going to sit in the sidelines and just wait for things to crash. And then he'll come in and buy up all the bargains. So, are we in the process of going into a crash? And well, that is what I'm going to get into here today on this episode. And I believe there is quite a few things that you need to analyze quite carefully before you make that kind of decision, because there's always a risk that you'll oversimplify it just basing it on, say, a price in the past versus having a look at some of the drivers and just make sure that you're calling it right. I mean, everyone has a bit of a crystal ball here and they're all kind of gazing in, wondering what's going to happen. But unless you've actually gone and analyzed it carefully, you really don't know. And so I'm going to see if I can answer the questions today. And so anyway, without further ado, let's get into the show. You are listening to Behind the Facade, and I am your host, Gavin J. Gallagher. On this podcast, I explore the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and your behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Hello, guys and girls. I just spent a lovely evening in Malahide Castle. There's a kind of a Christmassy show on at the moment called The Castle of Light. And just wanted to mention that. I brought my family along, and really, really excellent kind of a thing to go to. Lots of special lighting and all this kind of stuff. Very creative and just a lovely thing to go with the family. So just thought I'd throw it in there. That's what I spent my evening doing. And now I got to get into recording this podcast. So it's the start of another week, and I hope you guys are all suitably excited for what you're going to achieve over the next 168 hours. Now, 168 hours is a week, and something I strongly urge you all to get into the habit of doing is to have your top 3 priorities on a list at the very, very beginning of each week. And those 3 things are, no matter what happens, no matter what curveball you receive or whatever kind of crisis you're dealing with, that those 3 things are going to get done and ticked off your list. And they should be something that is part of your long-term goals that you are looking to achieve over kind of a sort of much longer time period. So it's critical to what the future that you're planning for yourself. But those 3 things are just stepping stones along the way. Anyway, that is something, just a little tip that I like to give out every now and then, as you know. Before I get into the main topic of the show, which is the analysis of what's driving the housing market, I thought I would just start with a little bit of an update from my mastermind program. And the reason I bring it up is because we're now just 6 weeks away from the end of 2021. And I'm sure, like me, you guys are all starting to think about your goals for 2022. What are we going to achieve in 2022? What are we going to smash? I'd like to smash things out of the park, as I say. And it's funny, I just thinking back to pre-pandemic, I was doing this exact exercise back in 2020 or in 2019, and I was thinking, okay, so many weeks away from a new decade, 2020, what are we going to achieve? And I was planning on all these incredible things, and sure enough, COVID struck, and it was a very different kind of 12 months. But having said that, I started the podcast, and here we are, 83 weeks into it, episode number 83. And One of the reasons why I got thinking about this is because some of you may be thinking about starting your own property investment journey as part of your goals for 2022. And it occurred to me that if that is the case, then perhaps you would be interested in joining my mastermind. And what I'm thinking about is a January beginning. And, a lot of people, they think that they're going to sort of start going to the gym or they're going to do whatever. And so if you are thinking about sort of doing something important in the property investment space in 2022, then I've thought about, let's call this a Black Friday offer. And what it is basically that you can commit now to join the program in January. It's I just need a small little commitment, and then I will put you down. But there's a kind of a whole special kind of offer where I reduce the price and things like that. If you're interested in this, then I have got a couple of things in the show notes for you to go and check out. But as a listener, I'm sure you're aware, the Mastermind was launched back in August. When I say launched, I guess what I really mean is I kind of soft launched it, because it really was just the beginning of this sort of journey for me. I hadn't figured it out, hadn't even thought through like the format of it or whatever. And I reached out on this podcast, and I asked if anyone would be interested in knowing more. And quite a few of you came back saying that you would. And in the end, a couple of you actually bit the bullet and jumped in, and I called those my founding members. And a great bunch of guys, really going places, and already a few of them have actually secured some nice properties. And so the reason I'm bringing all of this up is because I would like to think that you guys might be suitable for this program, and its official launch being in January, it would be something that you might consider joining as well. And so if that is of interest to you, I'm going to give you a website now. I'll give you the address, but I'm actually going to put it in the show notes, so you don't need to worry. But it's going to be www.elitepropertyaccelerator.com and then /offer. And that is going to bring you through to the offer. Now, I've put this in the show notes anyway, and that offer is going to be, I've basically put a video which explains the whole motivation behind the creating the program and how it's formatted and all of that kind of stuff. So it kind of explains it all, and then at the end it goes into the the special offer that's on. And I'm also going to throw in 6 weeks of free coaching between now and January. So if you happen to kind of commit now, you'll be joining the coaching immediately. Like basically as soon as you've heard this, you could be part of the coaching right up until the new year. So anyway, just thought I'd make that offer. Some of you out there might like to kickstart your new year, kick it off with a bang. I am going to be limiting this to the first 10 people who join my priority list. So if this sounds of interest, do not delay. Get onto me right away. There's an email in there that I need to receive to actually know to put you on the list and get you into that top 10. So, as I mentioned in the intro, there's a lot of people wondering about the housing market at present. Now, it's super hot, certainly that is the perception that it is super hot at the moment. And from the guys in my own mastermind that we've been talking about, some of them have been going along to auctions, and they used to go with cash to the auction. Well, when I say with cash, they'd be cashed up and ready to kind of pounce. They wouldn't have to go and borrow money from the bank or anything. They'd actually be sitting on enough money to actually complete the purchase of the property in cash. And they've noticed that suddenly, instead of it being them versus 4 other people or whatever, they're now up against 44 other people or something of that nature. And so it's just becoming a bit of a bidding sort of mess, and everybody's putting in their bid, and just when you think you've secured the property, another bid comes in, and it's gotten a little bit frustrating. So I thought that it would be something that we might kind of have a look at today in a little bit more detail, just to figure out, like, is this overheating kind of sense that we've got, is it what usually precedes a major crash? And I'm not sure it is. I'm going to be careful about how I present this, because, of course, things can happen. I'm certainly very wary of the market risks out there at the moment. Now, I did a whole episode not so long ago about China and Evergrande, and I do think that that could be a catalyst for a major kind of shock to the system. I also am very, very wary of the US stock market at the moment because the valuations are just astronomical. And when you hear them at the levels that they're going to, you just have to wonder, are we back in the kind of the dot-com bubble number 2? That I actually remember dot-com number 1, and it was just crazy. I mean, companies were putting .com at the end of their name and they were worth 500 million overnight kind of thing. It's just crazy, and it does feel a little bit like that now. And then lastly, we have the inflation issue that is definitely coming up. But the question is, will all of these turn into a massive crash? Will this be a trigger that kind of sets off this kind of domino effect? Let's get into that. Let's have a look at it. So what I'm going to explore today, I'm going to get into a couple of areas, but the major ones are obviously supply and demand. And those are very, very much interlinked, but they're completely separate from each other and how they're kind of created. And there's a thing called supply-demand tension. And that is a really big driver in terms of the pricing and the way the market is kind of behave over the next while. Now, beyond that, I'll be talking about, affordability and a few things, but affordability and risks, those are the ones that, they're also part of it. But in terms of the real drivers behind the market, supply and demand is the major one. So let's get a look at the supply. And to do that, we need to go back a little bit and just have a look at what's happened in the last 2 years. In March of 2020, most of the modern world entered into COVID lockdown. And this was an unprecedented, pandemic, all of that kind of stuff. Nobody had ever seen anything of the like. The entire world, or like something like 4/5 of the world, went into a restricted lockdown where they couldn't go outside the door more than a couple of kilometers. And it was really like quite a remarkable thing that happened. And you might remember there was images from Mumbai and stuff. You could actually see the Himalayas, whatever it is, 80 kilometers away. Prior to that, they hadn't been seen in something like 40 years and stuff. There was some just incredible stuff that was going on. And what it caused in terms of a supply kind of interruption was all of the building sites stopped work. The estate agents and the selling agents for property stopped showing property, stopped listing property, stopped going to the office. Factories stopped. Factories that manufactured, glazing, roofing, whatever it is, doors, carpentry, all of that stuff stopped. The companies that ship, timber and concrete and sand and, whatever it is, chips for computers, all of that also stopped. The boats stopped leaving the big ports because the ports themselves were in restrictive lockdown. I think the guys that were on the boats were able to kind of go sailing around the world because they were kind of a crew to themselves, but they couldn't actually disembark anywhere or be kind of unloaded or whatever because the people on the shore were unable to actually do anything. And then in addition to that, there was all these lockdowns, so truck drivers were kind of finding it difficult to get around, and they had to there was a lot of restrictions, and the whole world basically came to an abrupt halt. Now, I've often used the metaphor of the huge big super tanker kind of moving into a coast, and when it wants to stop, it has to think about that, about 20 miles before it needs to stop. And the reason is because it's got such momentum that it just takes that period of time to actually hit the motors into reverse and for it to actually eventually come to a standstill. And when you're talking about a kind of a global economy and you're talking about a market like a property market in any country, I'm not talking specifically Ireland here, I'm talking about the UK, the US, Australia, wherever it is, like for a market to kind of just suddenly stop like that for, months at a time, that is a major interruption. And it's just one of those things that when everyone sort of started getting back and you think, okay, now everything's going to fire up, it doesn't fire up overnight. It's going to take weeks and maybe even months for things to kind of get back on track. And as we have seen, this is playing out now. We're seeing trucks not able to kind of deliver enough stuff. An awful lot of people that went into the pandemic have decided not to bother coming out of it in terms of employment and stuff. I've heard like that a lot of people who were working have decided to retire. A lot of people who were working in kind of jobs that they didn't necessarily enjoy, they have been out of those jobs now for so many months, and they've been doing something else, and they've been using the support from the government to do something else, whether that's online or whatever it might be. But they've figured out that they're going to do that instead, and they're not going back. So there's been a major sort of upset to the labour market, and I think we all know that. I've certainly seen it on sites with deliveries being slowed down, and labour is gotten very difficult to get, first of all, and then when you do get it, it's a lot more expensive. So this had a major impact on the supply of housing units. And so there was a big fall off in the number of units being delivered. There was a big fall off in the number of units available to buy if they were secondhand units, and all of that leaving, I'm not even talking about the demand side. I'm just simply saying from the point of view of supply and delivery into the kind of what we call the inventory of the market, that has just been knocked on its head. And because of that, there is now a reduced inventory. You would normally, in any month, a kind of a typical market would have an average number of house sales or house closings that they would do. And if you've gone through, say, 6 months where not a single house could be closed, and then suddenly you come out of it, well, you've got all of the people that were looking to buy property during that 6 months, and that is all pent up. So the supply that should be there the demand that should be there is maybe there, but the supply has been stopped for 6 months. And so you don't have the inventory there that has been kind of continually adding to it. And so all of a sudden, there is now a shortage in the supply. And, that whenever that happens, when you restrict supply to something, if you restrict supply to anything, all of a sudden you'll find that typically the price will go up. So you'll see that, no matter what item you're talking about in the economy, and like oil is probably a good one, or if you look at, 1 year ago during the COVID restrictions, I can remember oil actually went negative in price because there was so much of it in the market. There was so much of it sitting on ships. They couldn't unload these ships. And because of that, the price actually went below zero. And I think it was something like minus $30 for a barrel of oil. And that was simply because there was so much of it. Now, all of a sudden, everyone's back and there's a shortage of it. And sure enough, prices have gone through the roof. Now, property acts in pretty much the same way. The market has been massively sort of short, and because of that, it is, the market is just, it's kind of reacting now to the fact that there's a big shortage on the amount of supply. The supply should have been pumping it out for the last 2 years, and it hasn't, and so there's an undersupply. But it's, one of the things that we got to be careful of here is that we don't simply blame COVID for everything. I think what we have to do is actually look back beyond the COVID pandemic and actually kind of dig into the statistics and consider the supply over the last, say, decade. Because what's very important is that if you look at what's happened since 2008, it's really interesting to kind of see what's happened to the supply. Now, you can look at this for any market, but I'm going to kind of drill into some of the Irish market. And I think it's not necessarily because I'm focused on the Irish market. It's actually just because the facts and the figures are kind of easy for me to kind of come up with off the top of my head. But there's a critical aspect in the supply equation, and there's different ways to work it out. From a statistical point of view, if you're talking about the supply and the inventory that a market needs, you have got to be thinking about the statistics, the census data. It's all based on population. Now, every single country has a government, and the government comes up with a projection as to the number of housing units that it's going to need to actually kind of come up with. And the reason it does that is because it needs to know that data. It needs to know how many schools do we need? Do we have enough teachers employed? What kind of transport do we need? How many hospitals do we have? Do we have the capacity of doctors and nurses for hospitals? Does the airport need to be expanded? All of this kind of stuff is predicted based on the data. Like they shouldn't, maybe it doesn't always happen, but they don't build stuff when they see that the demand is now crazy. They try to actually preempt it, and they try to kind of see that there's a population spike coming along, and therefore we need to kind of like get ahead of this, and we need to go and make sure that we have so many schools ready for when this population spike happens. Now, as the population grows, so does the supply of housing, in order to kind of give homes to people who are going to want that. And one of the reasons why that's important to government is because you're going to run into problems if there's not enough units, and that is going to drive up prices. It's going to make it an issue that becomes a bit of a complaint for the politicians, and politicians like to do things that get them re-elected back into office. And if you can't get a home for your kids, or if you're out there looking for a property and you simply can't find one, that is an unpopular thing and politicians hate that. So one thing I'm sure of is that the politicians do not want less housing. They want more housing, if at all possible. But the problem is that certainly in this country, housing is something that's done pretty much by the private sector. It's not done by the public sector. We do build, so many houses, and that's mostly for social, houses that kind of get handed over to people and things like that. But generally speaking, this market is driven by the private sector, and private sector meaning developers and funds and all of this kind of, the people that buy and invest in properties. Now, the affordable houses that the government want, that is effectively the reason they want that is it'll keep people voting. If you look up Google right now, type in how many housing units needed per year, and then just add in your country's name. And I just did it now, and it comes up, and I'm in Ireland, so it says here that it estimates that there are 30 to 35,000 units per year. That's the kind of the basic minimum that they need every single year without a hitch. They just need 30 to 35,000 consistently year in, year out. That's the delivery of units they need in order to kind of keep up with population demand. Now, if you look at the units, the number of units that are actually being completed today, and if you look back over the last 10 years, in 2020, we did 21,000 units. So we're a full 10 to 15,000 units off where we need to be just to keep up with the population demand. In addition to that, if you go back a couple of years before that, you're going to see that it's a real eye-opener, because after the 2008 crash, the supply of houses to the market dropped from, get this, 80 to 90,000 units a year to less than 10,000 units. And so for the years 2011, 2012, 2013, 2014, and 2015, only 10,000 or less units a year were being built. Now, back then, the population requirements were still 30 to 35,000 units per year, but we were only delivering 10. So every single year, we were 25,000 short during those years. Now, obviously, it was different types of buyers. So you might kind of cancel out, say, a couple of those years. But what you have is, at the time, you had rampant speculation. We were in a bit of a credit bubble. All of that stuff was going on. And so the guys were building 80 to 90,000 houses a year. They're putting them up for sale. People were coming along and buying them because they got easy money from the bank. All of that stuff was going on. But there was an underlying population growth that was feeding into it. And when you knock that on the head and you end up with 10,000 units a year being built for 5 years or 6 years in a row, you're just going to end up in a situation where you have this massive undersupply. And suddenly the population caught up with all of the oversupply left over from the 2008 and before. And suddenly you're into a situation where now you've got this structural undersupply of units. So where are we now? It's only in the last 3 years that we've actually gone above 15 to 20,000 units a year. And so even in the last couple of years where there's massive demand for property units and housing units, we're still not able to come anywhere near the delivery of that. And so we're going to be looking at a massive undersupply for possibly another decade or more. Now, the 2008 crash, the impact that it had actually was that most construction companies went into bankruptcy. And so the guys that were actually the directors and the owners and all that kind of stuff, they ended up, basically a lot of them actually went bankrupt themselves. Many of them moved abroad, and certainly an awful lot of the people that were like tradespeople and contractors and subcontractors and all that, they had absolutely no choice but to move to another country, because the Irish economy, certainly I can remember because I was living abroad, it was on its knees, and there was just no chance. If you were looking for a job, you just weren't going to get one, and so you had to go abroad and look for it. So there is basically no longer any of those people available to work in the sector today. And so the only capacity we have at the moment is to build 20,000 units. And that is flat out. That is like everybody being overworked. That is the bricklayers and the block layers getting paid a lot more than they were expecting to get. That is all of the laborers out there, as busy as they've ever been. Basically every single day of the week they're required on site. Deliveries on it are all slowing down because there's just so much demand and all that. That is our maximum capacity, is around 21,000 units at the moment. And so you can see we have a major problem here. We're unable to deliver the number of units to 30 to 35,000 units a year. We're only able to get 20,000 no matter how hard we try. So every year we're undersupplying the market. That is just going to make the supply issue even worse. And if you just multiply it out, like how many years now, 10,000 short, if it takes a year to build 20,000 units and every year you're 10 to 15,000 off, that means you really need another year just to catch up with where you should be. And so for every year that goes by, you actually need to build for 2 years in order to supply the number of units to that number of people. So we're in a difficult situation. Now, this is the case in the UK, I understand, and it's the case in the US. From what I've heard, all of the markets are very similar to this. They all have massive undersupply of units. And this is one of the major drivers behind everything that you're seeing these days. Now, the estimates at the moment, let's just go back to the Irish market for a moment. The estimates at the moment are that it'll take 16 billion euro annually in investment to get up to the level of 50,000 homes per year. Now, that is assuming that you can actually get the labor and the manpower and stuff into the country. If you're trying to get, people into the country to build 50,000 homes, you need to be thinking about where are they actually going to come from. Are they going to come from Eastern Europe or wherever, some part of the world? They're going to come in here and they have to go and find a place to live. They have to find a place for maybe their family to kind of live and go to school and stuff. Now, I have friends from that part of the world, and when they arrive here, they just can't find property. So already we're into a bit of an issue there. But second of all, where's the 16 billion going to come from? And at the moment, the only way you're able to get your hands on that kind of money is by going to the big foreign investors and the big funds. And that happens to be politically very unpopular. You're hearing an awful lot of pushback these days from people saying it's not fair. All the big funds are buying everything and they're getting the apartment blocks, and now they're starting to buy entire housing estates and stuff. That is because they're the guys with the money. And they're not going to come in here and, unless it suits them at the end of the day. And if we want to go and deliver 50,000 homes a year, that's the kind of thing we're going to have to do. So you can see the issue that we face. It's both politically unpopular, and it's also very difficult logistically, very difficult financially, and we're just in this difficult point where we're going to find it extremely hard to catch up with where we need to be. So, in short, the supply issue is not going away. It is not going anywhere. And the only thing that would change it is if demand were to completely change. And that is a good segue to get into the next part of this discussion, and that is demand. So demand is another component from the population curve. Now, each country is a little bit different, but Ireland is currently going through this stage where a large portion of its population are in their 20s and 30s. Now, if you go back to 2005, 2006 and stuff, an awful lot of those people were in their teens, and the government actually saw this at the time from the census reports, and they saw that there's a large number of teenagers, and so a lot of schools started getting constructed around about that time so that there would actually be the schools there for all of the kind of young people that were coming along. And this is the problem now, is that these people have actually matured and they're now in their 20s and 30s, and that is the age when people start looking to either move out of the family home or to buy their own place or to rent their own place and move in with their girlfriend, boyfriend, whatever it might be. And if that happens, then you're getting into a situation where the population, it feeds those government statistics. That's where the 30 to 35,000 comes from. And they need to know, all of that, as I mentioned, for the schools and for the hospitals and stuff. But that's where the 35,000 houses a year comes from. It's from that population curve. But in addition to that, we've also got migration to consider. And the migration, if you think about the country, it's viewed by many other nationalities as a very attractive place to relocate, primarily because of all of the jobs that we have to offer. You've got a huge tech sector in this country, and a huge number of the tech companies are hiring people because of their languages. And I know in East Point, we've got Google in there, and Google, they employ, I know when I go into the shop to actually kind of buy anything, there is every type of accent, and I can hear them all speaking to each other in Russian, in Portuguese, in French. I mean, it's just every different type of language. So there is jobs for any nationality if you come to Ireland, and that also features in the migration numbers, and we have to kind of add that into the figure. So with everyone looking for a place, then along comes 2020. COVID happens, and then the demand, what's going to happen? Well, everyone is unable to do anything, so you kind of have to take a breather and just wait until the market reopens. You still need a place. You still need to kind of move your family or do whatever you need to do. But because the supply was cut off, the demand is still there, but the supply was completely cut off. And that's when the market, those in the market that were ready to buy, they had to wait. And then those who were kind of further behind, that would perhaps kind of have come to the market 6 months or 12 months later, well, they actually joined the party and basically started sort of waiting for the next property to come along at the same time as the other people were sort of standing on the sidelines waiting for the market to reopen. So you end up with double the demand that had been there before. Now, let's think back again to 2008 and just consider, what about the demand for 80 to 90,000 units that was there back in those days? Well, the problem is, back then we were in this huge credit bubble and everyone was getting easy money from the banks. I can speak from personal experience. Like, we were speculating in property prices, and you bought something this year, you could sell it for 25% next year. The banks were just handing out money. The hurdles for borrowing were extremely low. On multiple occasions, I borrowed 110%, which covered basically all of my purchase costs. And so I could just buy things and just kind of keep on adding. And it was kind of a crazy time. And look, I've spoken about that in the past. But you talk about that as one of the reasons why the housing market at the time went crazy. Builders were just responding to the amount of people that were out there in the market with cash ready to spend. Now, is it easy to point to the same thing today? No, it is not. It's a very, very different market today. Why? Well, first of all, most of the banks got completely wiped out. They all lost all of their shareholders, lost everything, and it all ended up like bank owned by the government. So the bank rules and the regulations are today exceptionally strict. You just cannot get easy money from the banks any longer. In fact, speak to anybody who is trying to get it at the moment, and they will tell you that it's like pulling teeth here in the Irish market. I know now from speaking to my clients in the mastermind that it is easier, a lot easier in the UK to get money and to get investment finance for properties, and so I'll give that. But there is minimum income and debt limits before you can actually borrow. So here in Ireland, if you want to go and take a mortgage out on a home or something like that, you have got to have a minimum amount of income that they'll only lend you 3.5 times that income. Now in the UK, I understand that is 4.5 is the multiplier, and I mentioned in China it's something like 25 or 27 is the actual average now. So it's kind of crazy in China, obviously, and that is something that does look like a potential bubble that's going to blow up. But this demand is today, what you're seeing is it's demand that's actually needed. It's not speculators, first of all. And second of all, it is extremely well grounded in good lending practice. The banks that are lending out this money are not making it easy. And so everyone you see in the market who's trying to buy has been vetted by the banks, and they are not crazy people that are trying to kind of go out there and buy something as speculators. These are people that are just trying to get on the property ladder, or they're investors that have money and are able to achieve the various limits that the banks request. And also it's people of a certain age who want to buy their first home, or they want to, you've also got investors that are obviously renting out there because the rental market's very strong at the moment. Now I know at the moment you're in a situation where it's actually cheaper to buy a property and pay a mortgage than it is to rent it. You can actually, the same property would cost you more to rent than it would to actually pay a mortgage down. So anyway, with limited supply and such a strong and sensible kind of demand out there, we're starting to see a run up in prices. And why is it suddenly shooting up? Well, it's all of the demand arriving into a market that has this really badly restricted supply. And their supply has been restricted for about a decade. But in addition to there being that kind of structural supply, you've also got this added now headache of the COVID supply chain disruption. And that's creating a slowdown in the market. And all of this is just creating this really serious supply-demand imbalance. And I frankly do not think that this is going to change. I think you've just got those factors. The fact that the demand is based on population growth and all that means it's not going away. The fact that the supply chain is unable to deliver as many units as we need, and it will never be able to, or it certainly doesn't look like it's going to be able to do it anytime soon. Maybe in 5 years' time they'll achieve 50,000 units a year, and by that stage they'll start catching up, but it'll take at least another decade before you've actually managed to catch up. So you're talking about potentially another decade of this kind of supply-demand imbalance. So how could there be a crash, right? Well, not so fast. There are risks, and I did mention them at the start, but the one that I really want to talk about the most is, affordability. And, I do think that prices have approached a level that many people in current average employment just simply cannot afford, especially with those mortgage rules. So the same salary that everybody is on equals the same mortgage, or the size of the mortgage that you'd actually be able to take out. And I know that because when we are building our houses, we're very cognizant of the amount that people can borrow. If people are unable to borrow beyond a certain level, well then there's no point in us building houses beyond that level, because you just won't have buyers out there. You might find a very small, limited number of people who can go to that higher price, but then you're into this kind of limited number of people. Whereas if you want to have widespread interest in the properties that you're building, and the likelihood that you'll have, dozens of people being out there to buy them and pay you a strong price, well then that's what you do. You build more or less to that level that makes sense, that you know that you're going to be able to find borrowers that can actually buy that. So the biggest risk I actually see at the moment is inflation. And inflation, as we see, I mean, they're calling it at the moment, saying that it's at 4% or 5% or something like that. I can tell you that those figures that the governments use when they're talking about this stuff are so far off reality. I mean, anyone who's buying anything out there knows that the prices are much, much higher than that. I'm seeing kind of like 50% price increases, 100% price increases in some ways, and that gets passed on to the next purchaser. And so inflation is, at risk of getting out of control. And the only way the government can really rein in inflation when it does start to go out of control is to raise interest rates. And if they do that, if borrowing rates start to increase, then you're going to suddenly find that there's a major affordability issue. And at the absolute limit, like if you've got at the moment, the affordability of homes is already at the absolute limit with lending rates at the way they are, and the restrictions of the banks and all that. I just cannot see prices being pushed much higher. And yet, if you're talking about the actual interest rates increasing, well then I cannot see anybody being able to pay an increased rate. If you're going out and going after a property as a young first-time buyer, and you've done everything possible to kind of make ends meet, and you've gone out and you're borrowing at say 2%, how are you going to cover 3% or 4% if it comes along to that? And it's very possible that it will go to that, because if inflation is an issue, then you're going to have a situation where the rates do creep up, and even just a 1% increase could represent like 50% increase in the outgoings on your mortgage. So I do think if that happened, there will most definitely be a dent in demand. And what it would do would actually, it would push down prices, but not in a kind of a 2008 style crash down off a cliff. Because in 2008 what you had was 80 to 90,000 apartments being built for speculators, and suddenly the market, the rug was pulled from everybody. The banks just all went out of business almost, and so it went to zero. So the demand suddenly shot to zero. But if you're into a situation where the interest rates increase, the affordability, the demand will still be there, but the affordability will be the issue. And so what it could mean is that people will have to adjust their prices. I mean, there could be a situation where house builders might have to kind of like trim back the price a little bit, because otherwise they're not getting the affordability. You might have a situation where people that are out there trying to borrow money, just suddenly the bank's going to tell them, well, sorry, here's what you can afford, and therefore that's what your rate is. So people will have to look to buy cheaper properties rather than the one that they maybe had their mind set on. And all of this kind of stuff will come into it, but I don't see it as this massive, precipice cliff face that you kind of fall off of and it goes to zero. I do think that things could soften, but I think softening is quite different from what we're talking about that happened in 2008. And so I do think that because of the massive demand out there and because of the supply sort of issues that I've already mentioned, I actually think that prices could start to kind of stabilize pretty quickly, and that the market would find its feet again, and it would simply find its feet at perhaps slightly lower level. And what would happen is possibly more salaries would start to increase. I mean, if inflation is an issue, then the next thing that happens is that salaries start to increase as well. And if that happens, then the salaries will eventually catch up, and you'll get to the point where people can actually afford it. And then, as well as that, as inflation comes under control, it depends how long it takes, but maybe it takes a year, 18 months, 2 years for this to happen. And then suddenly the rates get dropped back, and they want to kind of prop up economic growth again, so they drop back the rates, and you'll find suddenly that people can actually start to pay that little bit more. So I just think that that is more likely to happen in the event of inflation. Now, that is not to say that there could be some sort of a massive shock, and I'm going to just, having seen 2008 and the way it kind of played out, it is possible that some kind of a shock could come along, and whether that's Evergrande or whether that's the US stock market. But I think what's going to happen most likely in a situation like that is there would be some sort of an immediate panic. Stock market investors would all pile out of any kind of investment speculation they were doing around housing and stuff. And so you might find that suddenly there's less people in the market looking to buy. But those people that I mentioned, the young people that are trying to find their first home, they're still all there. And the 50,000 homes a year that we need to build, we need to build that whether we're in a crash or not. That's what the population demand requires in order to kind of catch up and get housing to kind of a level playing field where there's a kind of a bit more balance in the supply and demand. And so if you're looking at that, when you've got demand that is so strong and just temporarily constrained by interest rates, then I think there's a chance that prices will stabilize and then demand will resume. And anyway, borrowing costs have risen by the corresponding amount. So you're not actually, if you're sitting on the sidelines and you're thinking about, I'll just wait for the prices to fall, and when the prices fall, then I'll jump in. But you've got to think about this a little bit more carefully. The likelihood is that the prices will have fallen, yes, but your borrowing costs will have risen. So if you're using, any kind of finance to fund your purchase, then you're probably going to be in exactly the same boat as you were before. The amount of rent that you collect and versus the amount of interest that is actually being paid out is going to be the same as before, because you'll be paying a higher interest rate for maybe the slightly lower price that you're paying. Anyway, guys, look, that is it. Between that and the stock market overvaluations and all of that, and then the possible impact that the Chinese market and inflation, there is risks there for sure. So don't throw caution to the wind and dive in. But I do think that if you can cover your borrowing costs, and definitely if you are currently looking to buy out there at the moment, you should be looking to fix your rates for a couple of years. And one of the reasons why I suggest that, it's always kind of unattractive to do that. If you go out now and start speaking to a bank and say they're quoting you 2% or 3% or whatever it is, and that will be the floating rate. If you go and speak to those guys and say, what if I wanted to fix it for 5 years? That 2% will suddenly become 4% or 5% or whatever it is. So it's going to be an awful lot more expensive. But the reality is those 5-year rates are, they're set by the expectation of what rates will be in a couple of years' time. And so whatever those current rates are is the likelihood of where you're going to end up at some point in the not too distant future. So you should be setting the rates that you're prepared to finance or the amount that you can afford. You should be basing it on the amount that the fixed 5-year borrowing rates are, because the likelihood is that's what the rates will eventually be. And I can remember doing that exercise in the past, and I can remember thinking to myself, why would I go and fix my rates? Like I'll be losing out on all of this extra profit rent that I'm getting now from not paying that interest. And then sure enough, within about 12 months, the interest rates were creeping past that level. And I can remember being a little bit, regretting, saying, God, I can't believe that I, turned that down. And now I'm looking back and I'm wishing that I had taken it, because now all of a sudden I'm going with the floating rates, and the floating rates have gone past that level, and I have no control over stopping them continuing to go up. So it was a bit of a lesson. And Anyway, guys, look, that's all I've got for you. I hope you've enjoyed this. I hope you found it useful. And again, be sure to go and check out the offer for the mastermind. And that's the show. Thanks for tuning into another episode of Behind the Facade. If you enjoyed this or found it useful, please take a moment to leave a review over on iTunes, or indeed share the episode out with a friend. This helps us grow the episode and reach more people. If you have any questions or topics you'd like me to cover in future episodes, please connect with me via the Facebook group Behind the Facade Community. Alternatively, you will find me on social media by my handle, Gavin J. Gallagher. You can stay up to date with all the projects I'm working on by joining my tribe. You can do that by adding your name over at gavinjgallagher.com. That's all for now. See you back here next week.